Hi, everybody. My name is Per Homer. I am a senior financial planning advisor with Assante Financial Management and part of the WWH Financial Group here at Assante. Today, I wanted to talk to you a little bit about the market, talk to you a little bit about staying calm as markets move. And obviously, we've seen over the past while a really positive move in the market over the past number of months or even more than a year now. And it's a good time to talk about what happens when it doesn't go as well as it has been doing recently. So this is our team, and we've got myself. I'm one of the advisors on the team, and the other two advisors on our team are Eric and Jeff Watchman. Jeff founded our team many moons ago, and we won't admit to how long ago that was. And Eric joined us about 5, 6 years ago. So we've got three advisors on our team. And then the people that really do the work are you've got Leah there, who helps us with clients and marketing. Joan, who's also talking a lot to clients, and our newest team member, Kashvi. And if you're getting this video through our newsletter, you'll also see a little video where Kashvi's introducing herself. She's an intern for the University of Toronto, Mississauga, helping us out 1 to 2 days a week, and she's amazing. So this is our awesome team. Over the past 3 years, we've seen a lot of noise in the market. You'll all recall that the markets kind of topped out in January of 2022, and most people had statements at the end of 2022 that they didn't enjoy. Why was that? Well, what happened was, first off, you started off with Putin invading Ukraine, and that made for a lot of concerns about the global oil and grains markets. And then you also had a drop as interest rates started rising drastically. Central banks started trying to fight rising inflation, and we've all seen in our grocery bills and other bills the impact of that inflation. The markets bottomed in about October of 2022, and since then we've seen stock markets rising. The blue line here you see is the U.S. stock market represented by the S&P 500, and the red line is the Canadian stock market represented by the S&P index. And so you have seen things rise, and over time we've seen inflation come back under control and back more into that 2% target that most central banks have in the world. And we have seen the start of decreasing interest rates again in Canada and the US as the market looks, as the central banks look to try to ensure that we have a soft landing and there's no large recession looming. Interestingly, from this, you'll see over the past 3 years that the US has outperformed Canada. If we look the last 20 years, you'll see a similar pattern with the US outperforming Canada. Canada seems to have fallen a little less than the US has, but also risen a lot less than the US has. So over the past 20 years, if you were invested in the S&P 500, you would have had a 400% return. And in the TSX, you would have only had a 172% return from this chart. But you'll see that, you remember back in 2008, we had the global financial crisis, which came to a head in October of 2008 with the bankruptcy of Lehman Brothers and bottoming there in 2009, March of 2009. The market then rose throughout most of the rest of the 2010s. You had some noise from an Asian crisis and a Greek crisis that barely registers on here. But then, of course, we all remember March of 2020 when the stock market basically fell precipitously because of concerns about the effect of COVID on the economy. Once the central banks opened up their coffers and put a ton of money out into the markets and to businesses and to everybody else through all the various acronyms that they had, you saw that markets rose. And then, of course, there's the past 3-year experience you have. But in general, stock markets move from bottom left to top right over long periods. So if you're able to weather the storm, stock markets are the right place to be. Some discussions about how to invest and how we look at this. Generally speaking, I recommend being a global investor. This is actually a map of the world. If you squint really hard on the left there, you've got North America, Canada, the US, a little green box for Mexico. You've got South America, which basically comprising of Brazil. And each country, and then you see Europe, Asia, and Australia. Each country is sized to the size of their share of the world stock market. The US makes up now 61% of the world's stock market. So when I first started showing this slide, it was around 50%. It's now 61%. So, and Canada is only 3%. China does have a much larger market, but it's very hard to invest in China. It's basically uninvestable. So between China and Hong Kong, you're looking at about 4% of the world's stock market. So what does this mean for us as investors? What it means is that, you see a lot of investors coming to us with their portfolios asking for help from wherever they've been invested before, and they have a large portion of their money in the Canadian stock market. That means they're extremely overweight or taking a big bet on that Canada will outperform the rest of the world, because Canada is only 3% of the world's stock market. So we try to make sure that we do invest in Canada because we believe in Canada, but we also try to make sure that we're staying global. So the long and the short of this chart is stay global. This slide here talks a little bit about downside volatility. So volatility is the ability for markets to things to go up and down, a time series or a market to go up and down over time. Downside volatility is when it goes down. And you'll see that the red bars show that it is normal occasionally for stock markets to go down, but more often than not, stock markets go up. The blue dots are interesting. It shows that every year during the year at some point, the stock market was down for the year. So at some point it was looked like it was going to have a negative return for the year. And more often than not, it recovers to have a positive return. So again, staying invested for the long term is the right choice. This also shows you that there are bull markets, which are markets where the stocks are going up, and there are bear markets where the markets are going down. Bull markets are green in this example, bear markets are red. What we see here is that, yes, the bear markets happen every so often, but they are two things. One is they are smaller in size than the bull markets. So the bull markets generally outweigh the bear markets, and they are shorter in duration. They don't last as long as the bull markets do. So this makes intuitive sense if you think about it. If we think that stocks are generally a positive investment and are going to make us money over the long term, we do need the bull markets to be larger and longer than the bear market. Makes sense. As well, this shows you an interesting chart since 2008. Some of the best trading days and the worst trading days ever. So the 20 best trading days are in green since 2008, and the 20 worst trading days are in red. So what often happens is that you have a really, really bad day where everybody sells stocks, and then the next day everybody says, well, that was ridiculous, and they come back and buy the stocks again. So you'll find that those 20 best days and 20 worst days are all clustered together. And what we as advisors try to do to help our clients is try to mitigate that urge, that knee-jerk reaction that, oh, it's a really bad day, I need to sell everything and get out of the market and protect myself. That's the absolute worst thing you can do. And over time, that will make sure that you don't hit your retirement goals or whatever goal it is that you have. People also get stressed. They say, well, this time it's different. There's something new, and this is why I shouldn't invest. And here's a list since 1950 of all the reasons why you should invest, starting with the Korean War and ending in 2023 with the US regional crisis. This is also kind of a fun trip down memory lane to go through and read different things and find different things that you think are interesting. Remember, in 1999, we all thought the world was going to end because the computer dates were being updated because of Y2K, and of course that all worked out fine. Nobody's cars failed and airplanes did not fall from the sky because everybody worked hard towards a goal. So this is an interesting slide. I enjoy this one greatly. And some people say, well, listen, and this is very valid, because if you do look back at here, you see, yes, the markets have done very well. You can say, are we at a peak? It's hard for us to say, and we really try not to time markets. And so one of the ways that we can avoid timing markets is by using a smart switch program. This exists with a few different fund companies, but CI, for example, which is our parent company, has the ability where you could say, let's say I have $10,000 to invest, and I'm worried that this is the top of the market, and I don't want to buy at the top of the market. So I invest my cash now, and it slowly gets deployed into the market. So what happens there? Put my $10,000 in, and 1/52nd of that 10,000 is invested every week into the market. And then, so after 52 weeks, you're fully invested in the market. And what happens to the money while it's not being invested, the other 50 seconds, and then 50 seconds, et cetera? What happens to that money? Well, it's sitting in a safe and boring money market solution, which at the end of August was yielding between 4.25% and 4.5% roughly. So you're still making a return on the money, but it's not at risk. And so we slowly put it into the market. And then, of course, you can change your mind and fully invest in the market if you want at any time. But this is a great way to participate in the market, make a return without trying to time the market, and reduce stress and anxiety and sleepless nights. So in summary, our general attitude is invest with managers you believe in, who buy good companies, and focus on the decades, focus on the long term, the moving from the bottom left of the chart to the top right of the chart. Don't focus on the intraday moves. If you want to do that, then really that's a whole different investment strategy, and that's day trading. Very, very stressful. So we want to focus on the long term, and that's kind of where we're at. If you ever want to reach out to us and ask us any questions, you know where to find us, or here's our phone number and emails. There's Jeff, myself, and Eric, and we'd always be happy to be here to help you. But I hope you enjoyed this little update. Look forward to providing more of these in the future, and I wish everybody a happy day.